Hello and welcome to sales return, our other type of stock return, being that we've already focused on a purchase return. So a sales return is when a customer or a debtor returns stock to the business, being us. So one of our debtors is bringing stock back to us. We sold them this stock on credit. They've got home, realised it's damaged, faulty, it's the wrong shape, the wrong size, or they may have simply changed their mind, so they bring it back to us and we issue a credit note. So a sales return reverses the sale. We have to create the expense of a sales return. So once again, we need to record this in our general journal, our general ledger, our subsidiary ledger, and our stock card. So as mentioned, we create an expense of the sales return. So this is the selling price of the stock when we originally sold it to the debtor. So we call that $500. Our GST is our 10% on there. So therefore our total debtor's control is going to be credited, because debtor's control is usually an asset, but because the debtor has returned the stock to us, they no longer owe us the money. So we need to decrease that asset. We decrease an asset with a credit. And so that's for the total amount, including the GST. Exactly the same as we did with the creditor's subsidiary ledger in the purchase return. We need to include the specific debtor details in the subsidiary ledger. So we've got our debtor, K. Rudd, which will also be credited for that $550 in the subsidiary ledger. So that takes care of our sale price. When it gets confusing is we also need to include our cost price. So just like a sale, when we talk about our cost of sales, our stock control, and our sales figures, we need to deal with both. So our stock control is going to increase. Stock control is an asset. We increase an asset with a debit because that stock has come back into the business. The debtor's brought it back. So imagine our cost price was $200. So our cost of sales was our original expense when we sold it, but now we have to reverse that expense. An expense is normally a debit entry, so to reverse an expense we need to credit for $200. So now we've taken care of the selling price and the cost price. The stock card is where it can get a bit tricky. So our details are going to be the credit note. In this case, our business issues the credit note. We're going to be working in the in column because the stock's come back in. Now, from our journal, we know that the cost price was $200. However, the credit note in this case is going to say $550 because we don't want our debtors to know what we paid for the stock. We only want them to know what they paid for the stock. So this is where we need to use our FIFO rules. And the rule is that for a sales return, the stock coming back in will be at the cost of the most recent stock to go out. So I'll say that again. So for a sales return, the cost price of the stock that comes back into the business will be the same cost as the most recent outgoing stock in the stock card. So in this case it was $200, because in our stock card we could have a balance within the same stock at different prices, but we need to record it as the most recent one to have gone out. And that is still in line with our FIFO, because FIFO is first in, first out, so the older stock is going to be going out first, so we need to replenish that. So a sales return, the cost price that we record in the stock card and in the general journal and the ledger will be the most recent out cost from the stock card. Once again, we simply go from the journal into our general ledger and subsidiary ledger. A debit to sales return, a debit to GST clearing, a credit to debtor's control, a credit to the subsidiary debtor K. Rudd, a debit to stock control, and a credit to cost of sales.